Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime Investors, Martin Maxwell here, and welcome back to our deep dive into farmland investing. Last week, we established the powerful why. We deconstructed the data showing farmland's history of strong, low volatility returns, its role as a premier inflation hedge, and the undeniable long-term trend of rising global food demand. Today, we transition from the strategic to the tactical. This is the investor's playbook. We're getting into the how. How do you actually add this asset class to your portfolio? We'll explore the different pathways to ownership, from buying a farm yourself to investing with a few clicks online. We'll break down how professionals value these properties, and most importantly, we will count down the top 10 costliest mistakes that can turn a dream investment into a financial nightmare. Investing in farmland is no longer just for farmers and massive institutions. A range of modern investment vehicles has emerged, offering different levels of access, liquidity, and control. First, you have the direct route, buying the farm. This is the most traditional path, suited for high net worth investors with significant capital and a willingness to be actively involved. My point of view is this: do not mistake this for a passive investment. Owning a farm is operating a business. It offers the greatest control and the full upside, but also the full weight of management and risk. For the vast majority of us, the complexities of direct ownership are a non-starter. This brings us to the passive investor's toolkit. First up are farmland REITs, real estate investment trusts. These are publicly traded companies that own and manage a diverse portfolio of agricultural properties. You can buy shares on the stock exchange just like any other company. The big players you'll hear about are Gladstone Land, LAND, which focuses on high-value fruit and vegetable farms, and Farmland Partners, FPI, which has a more diversified portfolio of row and specialty crops. The pros here are high liquidity and a low investment minimum. The con? Their share prices are tied to the volatility of the stock market, so they don't perfectly track the underlying land value. Next, you have equity crowdfunding platforms. This is a newer and rapidly growing model. Platforms like AcreTrader and Farm Together allow accredited investors to buy fractional shares of a specific individual farm. The pros are direct ownership in an identifiable asset and potentially higher returns than REITs. The primary con is illiquidity. These are long-term investments, typically with a 5 to 10 year hold period, and there's no easy way to sell your shares early. Finally, you can invest in agribusiness stocks and ETFs. This means buying shares in companies like equipment maker Deere & Company or seed producer Nutrien. You can get broad exposure through an ETF like MOO, but let's be crystal clear. This is an investment in the business of agriculture, not the land itself. Its performance is tied to corporate earnings, not farmland appreciation. There's a clear trade-off here. The more liquid the investment, the less pure your exposure is to the actual farmland. If you are considering direct ownership, a rigorous due diligence process is non-negotiable. This is the 360-degree property audit. It starts with legal and title diligence. You must get a new property survey to verify boundaries. Never trust old fences. A thorough title search is required to uncover any liens or legal claims. And you have to verify zoning, land use regulations, and legal access. But the biggest pitfall for beginners is failing the critical rights check. You must confirm who owns 100% of the water rights, mineral rights, and timber rights. If a previous owner sold those off, it could severely impact your ability to irrigate or prevent someone from drilling on your property. Next is physical and environmental diligence. In modern agriculture, water is life. You have to investigate the legal rights to use water, test the wells, and inspect all irrigation infrastructure. You need professional soil tests to determine fertility and check for any contamination from past pesticide use. Finally, you need a complete inspection of all infrastructure: barns, sheds, fences, and utilities. Deep due diligence isn't just about avoiding risk, it's about uncovering the hidden value that others might have missed. So how do you determine what a farm is actually worth? Professionals use two primary methods. The first is the income approach. This values a property based on the net income it can generate. The formula is value equals net operating income divided by capitalization rate. The NOI is the gross rental income minus the landlord's expenses, like property taxes and insurance. The cap rate is the expected annual rate of return. determined by looking at what similar, recently sold properties are yielding. If a farm is projected to generate a net rent of $350 per acre and the market cap rate is 3%, its value is approximately $11,667 per acre. The second is the market approach. This is the most direct method. It's all about comps. An appraiser analyzes the recent sale prices of similar farms in the immediate vicinity and makes adjustments for differences in soil quality, water access, or infrastructure. In a stable market, both methods should give you similar valuations. If the market approach is showing a value significantly higher than what the income approach can support, it's a signal that buyers are pricing in strong future growth, which could be a sign of an overheating market. Finally, let's run through the mistakes that can turn a great investment into a nightmare. 10. Having a short-term vision. Farmland is a long-term illiquid asset. Don't expect to flip it. 9. Ignoring the neighbors, research surrounding land uses and future development plans. 8. Failing to do a physical site review. There is no substitute for walking the land yourself. 7. Underestimating management needs. This is not a set-it-and-forget-it investment. 6. Ignoring tax and legal structure. How you structure the ownership has huge implications. 5. Using the wrong financing. Using short-term loans for a long-term asset is a recipe for disaster. 4th, botching the title check. A superficial title search is not enough. Get a full insured search. 3. Inadequate soil and environmental testing. You must confirm the land's productive capacity. 2. Overlooking water rights. In many regions, water is more valuable than the land itself. And the number one costliest mistake is treating it like urban real estate. Farmland has its own unique rules, risks, and value drivers. Applying a residential or commercial mindset will lead you to misjudge the property's true value. The playbook for a successful farmland investment is clear. It begins with choosing the right ownership vehicle, proceeds through rigorous due diligence, and concludes with a comprehensive financial analysis. Diligence is grounded in a disciplined approach to valuation and requires a keen awareness of the critical pitfalls to avoid. This is not an investment for the impatient. The returns are measured not in days or weeks, but in seasons, years, and ultimately generations. An investment in farmland is an investment in the foundational asset that underpins human civilization. It is a tangible hedge against an uncertain future and a rare opportunity to build a durable, productive legacy. Now, your challenge today, take the next step in your research. Go to the website of one of the crowdfunding platforms we mentioned, like AcreTrader. You don't need to be an accredited investor to browse. Look at their past offerings. Read through one of their investment memorandums. Pay attention to how they describe the property, the water rights, the soil, and the financial projections. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building, one smart move at a time.